You're now listening to the Tax Smart REI podcast, the number one tax podcast for real estate investors. Hey, thanks for tuning into this week's episode of the Tax Smart REI podcast. Today, Ryan and I are joined with Justin Shore to discuss a strategy that allows you to use rental losses against your earned income, so your W-2 or active business income, without the real estate professional status or the short-term rental loophole, and Justin is dubbing it Backdoor REPS. Now, before we dive right into all of this today, I want to say that this strategy has been around for decades and is not really anything new. However, due to its complexity, it's not discussed as often as it should be, but all of this is about to change today as we break down the strategy step by step, and then going forward, we can refer to it as backdoor reps so you'll know exactly what we're referring to, and we'll be breaking all that down in just 1 minute. Hey, are you ready to discover how to use real estate to build tax-free wealth? Well, this year, we're taking our annual summit to the next level by incorporating wealth-building strategies alongside our traditional tax and legal insights. Thus, we proudly introduced the 2024 Tax, Legal, and Wealth Summit for real estate investors taking place May 17th, 18th, and 19th, right from the comfort of your own home. This extraordinary free 3-day virtual event is meticulously designed to arm you with the strategies the 1% use to cultivate tax-free wealth through real estate. Whether you want to build, safeguard, or grow your wealth, this summit is your golden ticket. Visit www.taxandlegalsummit.com to reserve your free tickets today. Again, that's www.taxandlegalsummit.com to reserve your free tickets. We'll see you there, but for now, we'll dive right into today's episode. All right, and we're back. Justin, thanks again for joining us today. I know you've been on the show a number of times, but for people who are new or maybe not seen your prior episodes, would you be able to give the listeners a little bit of an overview of your background and how you got involved with real estate and real estate tax?
Yeah, sure. Absolutely. So I've been investing in real estate for almost 10 years now and been practicing in the accounting and tax space for a little bit longer than that. And I've always been very, very interested in real estate for all the tax benefits that it provides. So over the years, I just gravitated to it more and more. And over the last few years, I've been working here with a real estate CPA, leading the advisory team here on coaching real estate investors like our listeners on executing all these awesome tax saving strategies.
That's awesome. And I know you've been working really hard on something that you're dubbing backdoor reps. And it's exciting to be able to explore this here today. And we're going to dive into all of that in just a minute. We promise we'll get to it. But before we dive directly into backdoor reps, could we start with maybe just a brief overview of the passive activity rules and the real estate professional status itself, which is where REPS is derived from, where that acronym or that shorthand phrase is derived from?
Yeah, absolutely. So by default, all rental activities are passive from the get-go. The dilemma that we typically run into is if we know that we can generate real estate losses using things like accelerated depreciation to do so, but the problem then is if we have non-passive income like a W-2 of some kind or a spouse's W-2, when are we able to use the real estate losses to actually offset not just rental income, but W-2 income? And real estate professional status is one of the primary ways to be able to do that. But it is a pretty heavy lift. You know, it's not something that you can just go out and decide, hey, I'm going to do this tomorrow, or I'll try and get this done in the last 6 months of the year even, because it requires a pretty hefty amount of involvement in a real property trader business to do so.
Right. So reps, basically what the real estate professional status allows you to do is take losses from your rental properties and use them against your earned income, which is typically W-2 income or income from an active trader business or other non-passive income, perhaps like portfolio income, right? And in order to qualify for reps, you have to spend more than 750 hours and more than half your total working time in a real property trader business. Now, if you're working full time, this is virtually impossible. Your spouse could qualify, but if you're both working full time, then you're in a little bit of a pickle, as they would say, and it might not be viable. And of course, there's the short-term rental loophole, which is another workaround, but that's not what we're focusing on today. If you do want more information on the real estate professional status, if you want a deep dive, there's a lot of nuances regarding it. You could check out our REPS series. Just scroll down the Tax Smart REI feed and you'll find it. It's back in 2021. However, not much has changed, if anything at all, for REPS since then. So it's still highly relevant. Probably some of the best content that we've ever done here on the show has been that series. Same thing with the short-term rental series as well. You can check that out if that's what you're interested in. But moving right along here, so now we have an understanding of what the passive activity rules are, what REPS is, and why it's not always feasible for everybody to get REPS. For those who do want to turn their losses non-passive to reduce tax on their earned income, this is another option. Backdoor REPS is another strategy that if you plan for it, you could utilize it. So Could we dive a little bit further into this? I do know that when we do sell a rental property, passive losses are unlocked. So how does that work, and how does this all fit into this big picture of this strategy, backdoor reps?
Yeah, so the reason why I'm so excited to be talking about this today is, in a nutshell, if we had to kind of summarize what the big benefit here is with the strategy is we are able to effectively offset your W-2 income with real estate losses potentially without qualifying as a real estate professional or using the short-term rental exception or i.e. loophole. So very, very exciting. That's why we're coining this term backdoor reps, is we're effectively finding a subtle, nuanced way around the stringent requirements that normally would be in front of you for qualifying as a real estate professional. So what this stems from is we know that you can offset your passive income sources with passive losses. But from a more detailed perspective, it's a little oversimplified to say that. So what we're really actually doing is when we have passive income of some kind, it is allowing us to use the passive losses, or what sometimes people say is unlock the passive losses. But the key here is that you can have passive income that is ordinary, and you can have passive income that is capital gains. And that's what we're going to focus this strategy around, is the difference between what's just ordinary income and losses versus what is capital gain and capital losses.
So Justin, maybe give us a little idea about the different types of passive income, right? Tax rate, capital gain, kind of passive gain there. What is kind of this, maybe we might call arbitrage between those differences there in tax rates?
Yeah. So essentially, when we have ordinary income, or and same thing when we have ordinary losses, and this would just be if you have rental losses, maybe thanks to accelerated depreciation on one or multiple properties, the ordinary tax rates are going to apply. So that could be your 24, 32, 35, 37% effective tax rate. But when we're looking at capital gain income, you're going to be in those preferential tax rates. And it could be as low as 0%, but most investors are going to fall in a 15 or 20% long-term capital gains rate. So what we are effectively doing here is if we have a rental property, let's say that we go to sell a rental property that we've owned for a few years. It's gone up a lot in value. Say you originally bought it for $300,000, now it's $400,000, and you go to sell that property. You're going to recognize a $100,000 capital gain in the current year. There might be a little bit of depreciation recapture. We know there's a lot of variables involved there because you could have just been taking straight line if you hadn't cost segregated the property or something like that. So we don't want to completely ignore depreciation recapture in most situations, but for the sake of not completely overcomplicating all the calculations here, to kind of keep this a little bit easier to follow, we're going to focus there mostly on the fact that the majority of the income you have on this property sale is capital gain in nature. Now, what's going to happen, though, is that capital gain of $100,000, it's going to go to two different places. It's going to travel over to the Schedule D, where capital gains are referred and then calculated, but it's also going to flow down to the Form 8582. And that's extremely important because the Form 8582 is where we are able to net our passive losses against our passive income. And more specifically, what that form is doing is saying, okay, if you have $100,000 of passive income in the current year, it's going to effectively unlock any passive losses that you had. And maybe these passive losses are from prior years. Maybe it's a combination of other properties that you had losses from cost segregations that are being carried forward. Maybe it's syndication investments. There's a lot of different sources that you could have those prior year passive loss carry forwards coming from. Now, the beauty of this is that when that 8582 allows $100,000 of your passive losses, which were originally recognized as just ordinary losses from these rental activities, that is going to flow up to the Schedule 1 on line 5. That's where your net rental real estate income and loss is really first summarized almost. You can look at it that way. But then it's going to go from that schedule to the actual face of your 1040. And you're going to see that showing up. And you could have other business income mixed in there. But again, we're just going to assume all you've got is your rental income and loss coming from that Schedule 1. That's going to show up on the front of your 1040 on line 8, where all of the other income is flowing from. The interesting thing, though, that we want to point out is that number even though that 8582 is releasing those losses, allowing you to take them, even if you are not a real estate professional, those are going to flow up to the face of the 1040, and you'll see that negative number reducing your adjusted gross income. Now, you will see your capital gains also meet back up with these rental losses on the face of your 1040, but because they are capital gains in nature, they're going to come through on a different line. They actually will pop up on line 7. And the importance here is that they are consistently being tracked through the return thanks to their differing natures, to the fact that you've got capital gains and also ordinary income and losses. But at the same time, they're both being tracked as passive. And that's a really, really critical part. So ultimately, probably one of the easier forms to actually understand on the tax return. And I don't want to talk, too much about the forms and be like, oh, this is a class on filling out your tax return or something like that. But the front page of the 1040 is relatively easy to follow in that you can see all of your sources of taxable income and potential sources of tax losses, basically all just adding up against each other. So you have things like your W-2, other business income, rental income or losses, capital gains, all that's showing up right there. And eventually you add all those together just to arrive at your adjusted gross income. So once we've gotten to that point, what you'll see there is you've got W-2 income and your rental losses effectively being netted against each other by time they actually get to the what you could call the subtotal or your adjusted gross income, that AGI factor.
Hey, are you tired of working with generalist CPAs that tell you can't use the real estate professional status, the short-term rental loophole, or cost segregation studies, or worse, have no idea what these things are? If so, it's time to elevate your game and work with a CPA firm that gets it. Here at Whole CPA, we worked with thousands of investors, helping them save millions of dollars in taxes through proactive tax strategy and planning, tax preparation, and outsourced accounting solutions. So if you're ready to elevate your game, make tax filing painless, and save thousands of dollars in taxes, what are you waiting for? Just head on over to www.therealestatecpa.com/podcast to request an initial consultation today. We are accepting clients for the 2023 and 2024 tax years, so if you're looking to make a change, you have nothing to lose. Again, you can request an initial consultation by visiting www.therealestatecpa.com/podcast. We look forward to hearing from you and learning more about your situation and how we can help. But for now, we'll dive right back into today's episode.
And that comment there, I feel like is that exactly what REPS is doing, right? What REPS is doing, right? Forget the backdoor REPS for a second. What REPS is doing, just to circle back to the beginning of our discussion, we're basically taking rental losses in that current year after meeting REPS and now being able to offset other income like W-2 income, business income, whatever you have, other non-passive. But this is effectively doing the same thing when we've got passive losses that were kind of maybe prior, right? Primarily is kind of what the distinction we're going to be talking about here in a little bit. Taking those passive losses from the past, unlocking them to then offset things like your W-2 or business income. So we're offsetting now at your ordinary income tax rates. And so maybe from here, we could just talk about like, if that's the case, who is this a good option for? Like, how do people work this into their tax strategy? Because I imagine as we think about ordinary income tax offsets, this is going to be most valuable for people in like the 37% bracket. So maybe let's just kind of talk about like, who is this the best for and how can investors actually use this?
Absolutely. So I will say it's going to be advantageous to investors that are in varying different like tax brackets. So I don't necessarily want to say that this can only be used by upper income earners. And the reason why is when we look at this arbitrage between the two different tax rates that are at play is if you're talking about, an individual who is in say a 35, 37% tax bracket, their long-term capital gains bracket is going to be around 20%. And then some of your investors that are in, say, like the 22, 24, 32% tax brackets, they're going to be looking at 15% capital gains rates. And there's a little bit of give and take there where the edges of the brackets are actually located. But for the most part, those are kind of like the two main sections. But, to go to the extreme, even somebody who is in, say, like a 12% tax bracket could be utilizing this strategy because they're most likely going to fall in a 0% capital gains bracket. So if we kind of slice that into the three different, maybe if you could say like the different levels of investors that are maybe listening to this right now, lower income earners, you're still going to have a delta or a difference there of 12% at a minimum, I would say. And then the middle grouping is going to have that difference probably ranging in like the 9 to 17% range. And then your upper income earners are going to have a delta that's probably 15 to 17%. So they are going to vary a little bit from one tax bracket to another. But ultimately, investors of all different areas of tax rates, marginal tax rates, could utilize this.
So maybe let's dive into from that, like what would be some ideal scenarios, right? Because if this is primarily looking at passive losses that we're unlocking, we got to have a situation where we've got prior or passive losses. So maybe let's just kind of talk about who is this a good fit for from here?
Yeah, it's definitely going to work a lot better for investors that have a little bit of an established portfolio. And, that could be that you've got 3 units or you've got 10 units. It is going to hinge a little bit on that. You most likely have at least a few properties at this point in time. And the secondary component would be that you have property that has substantially or fairly substantially appreciated in value. Because as you can probably tell at this point, a lot of what we're talking about here is the existence of capital gains, and capital gains being that appreciated value. And that's why I'd say, it doesn't necessarily have to be that you have a dozen units already. Maybe it's that you've been buying a property every year or two for the last, 5 years or so, but you've got that first one that you acquired has now gone up in value, say 30 or 40%. I know the last few years have been very kind to us as far as appreciation rates and whatnot. So we definitely want to have that element present. So we need to have a property there that is experiencing or has experienced a relatively high amount of appreciation. And I know we're kind of using some vague terms of just high, relatively high. What I would say there more specifically, if you're looking at your specific situation, like your individual, tax return, is at the end of the day, we would want the capital gains you're experiencing on a sale to just pretty heavily outweigh any kind of depreciation recapture that you might be experiencing from the property. If your property is being sold for 5 to 10% more than what you bought it for, there's not going to be a whole lot of meat on the bone here for you, because again, what we're working towards is tapping into the difference between what your capital gains rate is and what your ordinary tax rate is to really capitalize on that differential between those tax rates.
From that, let's say you acquire property in the same year. Could that then be cost segregated and use those losses as well to kind of do a backdoor reps scenario as well?
Yeah, that would work. You say acquire a property. Here we're recording this in April 2024. Maybe you acquired a property in February of 2024. So it's new to you. So there's potential for using bonus depreciation on your 2024 return. But now, after hearing about this and hearing that, okay, there's a lot of benefit I can tap into here, I've got a property that maybe I acquired back in, let's say 2016. So I've had it for, 7, 8 years now. Back when I first bought it, I was a new investor. I didn't know anything about depreciation, bonus depreciation. I didn't do a cost segregation study or something like that. But here I am sitting on a large capital gain because I've owned this property for 7, 8 years and it's gone up a lot in value. The question you could be asking is, could I tap into this by, again, offsetting my W-2 income by using the losses from the property I recently acquired this year, and then actually selling my older property and recognizing those capital gains? That would be, a good example or ideal scenario that you could utilize this in.
So speaking of properties acquired perhaps in prior years, circling back around to that, there's always clients or taxpayers, people listening to the show who may have acquired a bunch of properties last year, 2 years ago, 3 years ago, whenever, but they did not do a cost segregation study, and therefore they don't have large losses, passive losses as a result. But we know that could all be changed. Retroactive cost segregation studies and the Form 3115, change of accounting method. How does that play into the strategy, if at all?
Yeah, so that's another workaround or another example of a situation where you say, well, if you said, Justin, I'm not buying a property this year, so I don't have a new one that I could necessarily, but I do want to sell one of my other properties. What you could do is, if you were selling this property that you bought, 5, 6, 7 years ago, but there was a property that you acquired maybe in 2022 and didn't do that cost segregation study, what you could do in 2024 is have that study performed, use the 3115 to do the quote unquote retroactive bonus depreciation on that property in the current tax year. And that would be another way to tap into this. Again, recognizing that large capital gain from the sale of one property, using one of the existing properties in your portfolio to accelerate those losses, and again create ordinary losses in 2024 while at the same time creating passive capital gains in 2024. So as you can probably tell, there are a lot of different scenarios in which we could utilize this. It's okay. The more straightforward one is maybe you're acquiring a property this year, but maybe that is not the case for you, for whoever's listening to this. Or it could be that, yeah, I've got a ton of these passive losses that I've built up in prior years, but I've failed to hit real estate professional status. And now I'm trying to figure out, is there any way that I can potentially tap into these? We also have a lot of questions from clients that will say, well, I've been doing this stuff with real estate and I've done these cost seg studies and I built up all these losses. If I hit real estate professional status now in 2024, will that unlock those? And actually, the unfortunate answer in that scenario is no. Just hitting it in the current year does not unlock those prior year losses. So this is actually a potential workaround to that scenario as well.
So in summary, kind of what Justin's saying, I feel like there's kind of three aspects. So number one, you simply use passive losses on your form 8582 from prior years, right? Before even considering any other new cost segs. Option two is maybe you've acquired a new property and you're going to perform a cost segregation study same year. Option three is that you look at properties you've acquired in prior years and you're going to do a cost segregation study now in this current year when we've got the sale, and you're going to use form 3115. So it seems like there's essentially those three main strategies. Is there anything else to add into that?
Yeah. And, given the timing of the year here, we are in April 2024, is that if people may be listening to this and have just recently had conversations with their tax preparer who said, hey, in 2023, these properties that you acquired, you shouldn't do the cost segregation study on them, or you shouldn't have bonus depreciation applied because it's not going to benefit you. Or we hear sometimes preparers will actually say you can't take bonus depreciation, some combination of that. But after hearing this potential option for how this would impact your, say, 2024 tax year, you may want to go back and say, no, I do want those cost segregation studies and the bonus depreciation applied to my 2023 return because, yes, albeit I didn't qualify as a real estate professional last year, I want those passive losses from those couple of properties I bought to be sitting on my 8582 carrying forward into 2024 because I want them to be there and be ready for the property that I think I might sell in May or June of this year, so I can tap into this strategy. So it is almost like a fourth option. It's another time traveling strategy. It was one of the few things that you can make that decision on after the tax year is actually over.
Yeah, one of the few things. Then from there, you've got proceeds from selling the property, right? Assuming you've got some good amount of proceeds, because we're talking about properties this is going to be good for. You've got some good amount of appreciation, right? And then we've got potentially some tax savings. Okay, I've got now more tax dollars in my pocket. Is there anything else that people should be doing tax efficiently with those proceeds? Like, should we put it into another property or anything like that?
Yeah, I think we have to address the elephant in the room to some degree. I know in like the last several weeks and on the podcast, we've been talking about the pending updates that there may be with the current tax bill that's being debated in the Senate that could reinstate bonus depreciation back up to 100%. But right now, as the law is currently written, it's 60%. So this is the other details. Like this strategy does hinge a little bit on the ability to use bonus depreciation. So you might be listening to this and hearing like, okay, this is all fine and well, but if I use this strategy to acquire, maybe I don't have any prior passive losses, or maybe I don't have properties from prior that I owned in prior years. I could do the 3115 with. Maybe none of those things are applying to me. So what if I go and buy a property this year, but now I can only get 60% bonus depreciation on it instead of 100? I would say it's in most cases, it's still going to be very, very beneficial just because, again, you're still benefiting off of that large delta between the differing tax rates. But another option that might be out there for you, and again, this would be something, a situation where you might need to be an accredited investor, is you could invest into something like a syndication that's investing in a specialty asset class, like the things like car washes, ATM syndications, things of that nature that are notorious, or mobile home parks. I kind of forgot to mention that one. But these asset classes historically will tend to generate a much, much larger amount of bonus eligible property than, say, a traditional like single family home. So that would be an alternative if you were concerned about, well, it's a 60% instead of 100% bonus depreciation. That could be another potential avenue or potential workaround for that situation.
No, these are all great strategies, and I'm really glad we're able to unveil this and put a name to it. I'm sure we'll be talking a little bit more about that in a second. But before we go any further on that aspect of it, So we kind of went through the pros and how this works and some situations where it might be beneficial. But, nothing's without downsides, right? Nothing is ever perfect, right? So what are some potential risks or perhaps downsides that investors may need to know who would be considering using a strategy like backdoor reps?
Yeah, I mean, a situation where you'd be exposing yourself to a little bit of risk, I would say, again, if you have very little gain that is attributed to long-term capital gains specifically, if you're selling a property that you've only owned for a year or two, it hasn't appreciated very much, and maybe it was one that you actually cost segregated in the past, so you're going to experience a large amount of depreciation recapture. If you have a lot of your income, I'd say a larger portion of the income from the sale showing up as depreciation recapture as opposed to long-term capital gains, your benefit's going to be severely diminished in using this strategy. And that's because your depreciation recapture will most likely have 1245 and 1250 and unrecaptured 1250 gains. So there's going to be a myriad of different tax rates at play, as opposed to just worrying about the 15 and 20% rates as being your primary concern. You might have depreciation recapture that is at that marginal tax rate, the 35, 37% tax rate. So that would be, scenario number one that I would say, as far as like, if you wanted to call it a risk, it's more so just like a diminished effect that you would experience. And then again, like I mentioned before, if you're in a lower tax bracket, the effects of this are also going to be a little bit lower, still can be relatively beneficial. But for example, if you're in a 22% tax bracket, then your long-term capital gains, like I mentioned before, be 15. So the differential there is only 7%. So there's not quite as much, effect compared to someone who's in a 37% tax bracket that's getting a capital gains of 20. So they're having a little bit more than double the amount of benefit there. The other situation, like I said, a bit of readdressing the elephant in the room, is that bonus depreciation, as it gets closer to zero, you're going to have a harder time accomplishing this strategy in full. So that's something that luckily, at least like right now, I would say we'll be concerned with maybe in like 2026, 2027. But even at the lower rates, like 60%, 40% bonus depreciation, it'll still be very applicable this year, next year.
That's a good thing to re-mention here, because I actually just got off a podcast a few hours ago where somebody was talking about banking passive losses. So in other words, making strategic investments today, of course, as long as there's investment merits, we don't want to let the tax tail wag the dog, while bonus depreciation is 60% to lock in passive losses. They were speaking about it in the context of real estate syndications and being able to offset future gains with passive losses. But I think the laddering strategy, or the banking of passive losses strategy, if you will, meaning accumulating more passive losses today while bonus depreciation is at 60%, does apply here. So this kind of goes across the board. If you do want to capitalize on bonus depreciation and you do have assets that do make sense for you to acquire, now would be the time to acquire them if you want to be tax conscious, if you will. And again, we don't want to let the tax tail wag the dog. Having said that, I do want to just shift gears here a little bit. While backdoor reps is a new term that we're mentioning here today, this strategy has actually been in the tax code since way back since the passive activity rules essentially been passed back in 1986. But something that we've learned here on the show and in the tax smart investors community as a whole is that putting names to these types of strategies does help the real estate community at large communicate these strategies. Like, we just spent the last 30 minutes or so going through what this strategy is, how to use it, when it's right, when it's not right. But if you just, after learning the strategy, if you just say backdoor reps, now all of a sudden you, boom, know what it is. And the same thing with the short-term rental loophole, right? For example, that's just a name for the term. And there's reasons why there's that name, of course. But it's a name that caught on within the real estate community, because we all know for the short-term rental loophole, for example, you have an average stay of 7 days or less. You need to materially participate 1 to 7 tests. You use cost segregation and bonus depreciation. And then you can turn passive losses on your short-term rentals non-passive and offset your W-2 or active business income. All that is said and communicated in a single term short-term rental loophole. Same thing with reps, right? Real estate professional status, even though that's been the name of it, the official name of it, reps has kind of become the shorthand name, and it travels around the real estate community. So I know a lot of CPAs, EAs, tax preparers out there hate these names that get coined. But I think, if you're listening to this and you're CPA, EA, what have you, you have to take a step back and realize something here. This stuff is incredibly complex. Again, we just spent the last 32 minutes talking about this. And most real estate investors, I know some are, but not all, most aren't tax professionals, most aren't tax attorneys, don't have tax backgrounds. And to be able to coin or put a name around something to communicate a complex topic in just a single name really goes a long way in helping your clients understand and helping real estate investors at large understand how these complex strategies work and how they can communicate them back and forth to each other as well as to their tax professionals. So I know that's something super interesting. I want to see if you guys had any thoughts on that.
Yeah, I just want to clarify, like what Tom's saying there too is this isn't something that's like aggressive or dabbling in a gray area or anything like that necessarily. It's just that it's very minimally understood by and large because it's combining several different complicated components of ordinary versus capital gains, and it's looking at like what the passive activity rules and when losses and income can actually offset each other. But at the end of the day, it is all very clearly black and white outlined between the tax code and then also between the tax forms themselves. So just want to make it clear there. We're not necessarily, it's not like we're manipulating the forms or anything. This is actually just the process you are supposed to follow when these types of transactions occur. The key here is knowing that that's how they actually are supposed to occur, so that when you're presented with the opportunity to potentially tap into that you feel comfortable and you feel confident knowing that this is a tax beneficial strategy that's currently available to you, so that you're not kind of, scaring yourself out of either not selling a property when it actually could be advantageous to you, or the other thing that could be is you don't want to necessarily rush to, say, acquire a property if you think that that is the only solution that is currently available to you. But as we kind of outlined in all the different scenarios, and we could probably throw 10 or 12 more out there where this would be applicable, is, I know it's a little bit self-serving for us to say this, but it makes it more apparent of how unique your situation specifically can be with your portfolio, because it can matter when the properties were acquired, how long you've held them, how much they've appreciated, and what other various options are at your disposal. So definitely consult with your tax professionals before, don't want to just jump the gun, go off half-cocked here or whatnot, to try and pull one of these strategies off, because there is a lot of consideration to it.
One thing I was just going to add in here too, as we're talking about this, I would not want someone listening to this to get the impression that this is a tax elimination strategy, right? Take someone who is going to sell a property, they're maybe in the 37% bracket, you're still going to pay capital gains at 20%. Right. So I wouldn't want someone to be like, oh, great, I can just get all these losses and have no other income being coming through. Right. So just be careful. This isn't like just using reps where you could potentially significantly increase a whole lot of your income. This is like, you've still got to recognize that gain, right? That's the arbitrage, right? The difference between the ordinary income rate versus the capital gains, but we've still got to pay this capital gains rate. So just be careful there as you're thinking through this. This isn't like, oh, great, I can eliminate all my tax for the year by doing this kind of backdoor that we're talking about. So just be careful. Just want to put that in there for people listening.
Yeah, no, absolutely. And I just want to reiterate too, that this isn't anything particularly new. Like we talked about, this has been around since 1986. It's just like Justin said, so widely misunderstood and so complicated to the point that it needed to be broken down and it needed a name so that it could be communicated more readily. Because when we've talked about this, I'm sure here on the show a number of times, but the reason why we don't talk about it more is because, again, how complex it is. But now, after listening to the show, if we say backdoor reps, you know exactly what we're talking about. And again, for all the CPAs, EAs, tax professionals out there listening to this, it's just a way to communicate the strategy to people much more easily than explaining the entire thing. So that's kind of the point of this segment of the conversation, was just to kind of shine some light on why some of these strategies have unique names that aren't the official names for this stuff. But this is all under Section 469. This has all been part of the Tax Reform Act of 1986, dating back, it's almost 20 years now. What is it? Almost 40 years. 38 years? I'm doing my math right. So it's been around for a long time. We're just putting a name to it. Same thing with the short-term rental loophole again. But, before we wrap up, I know we had some more questions, Ryan, right? We had some more questions about another strategy that this is similar to, but not quite the same.
Yeah, maybe we could, just for a minute, a lot of people listening to our show have heard us talk about, we've called it multiple things, but right, the 1031 exchange light or the lazy 1031. Maybe we could just for a minute help people understand the difference in the two strategies. So Justin, maybe you could just help us kind of distinguish between those two as we think about those two, right? We're kind of talking about naming things. That's kind of the naming that we've come up with these two things. So what's kind of the main difference as we talk about this?
Yeah, probably the biggest thing is that with the 1031 exchange light or lazy 1031 is that it is predicated on you acquiring another property in the same year and then utilizing bonus depreciation on that to offset the gains that you experienced on the property that you sold. The key there is it has to be done in the same calendar year. So it is a little bit more restrictive timing wise. And that's why we did, threw that out there as like one of the many options that you could utilize to execute this strategy. But if you are in that scenario, as like investors, if you've been doing this for a little while or been doing it for a long time, you may have ran into that experience where there were times where you found it kind of difficult to locate a deal that really penciled out that you really wanted to, especially right now in these higher interest rate environments. They're starting to get a little bit better now. But we had a lot of clients over the last 18 to 24 months, I would say, when those interest rates were climbing, that we're finding it a lot harder than it used to be to acquire a property that made sense. So that's why I'd say it's really nice knowing that you have other options out there other than being forced to necessarily acquire a property in the same calendar year. So I'd say that's probably the first, the main difference between the two.
So that was awesome. Another strategy in the tool belt of real estate investors, backdoor reps. You heard it here first. Okay. It's probably get used by a bunch of people, but that's okay. That's the nature of the beast here. If you are interested in using strategies like backdoor reps, the real estate professional status, short-term rental loophole, cost seg, anything in between, these are strategies that are complicated and you generally don't want to go it alone. You want to have an advisor who can help make sure that it applies to your situation in the way that it needs to, so that you don't make any mistakes that could cost you a lot of money in taxes, and so that you can actually reap the rewards. So if you are looking for a CPA who knows the game, who understands this stuff, we work with real estate investors across the United States. You can request an initial consultation today by going to www.therealestatecpa.com/podcast. We only accept a certain number of clients per week. So now is as good a time as ever to get that conversation started. Again, that's www.therealestatecpa.com/podcast. And also, if you're a CPA, EA listening to this and you want to make a jump, you're looking for a real estate CPA firm where you can grow your career, we are highly rated and we're one of the number one shops for doing that. So if you're interested, you can apply today by going to www.therealestatecpa.com/careers. We'd love to learn more about you, and if there's a fit, bring you on board the team. So that is all for today. I want to thank everybody for tuning in, and we'll catch you on next week's episode of the Tax Smart REI podcast.